Tired of being in the dark about your investment? How does your portfolio's performance really measure up? Is your investment plan on or off track? Get the answer at PortfolioReportCard.com. Ron DeLegge's grading system of A, B, C, D, or F will tell you if your 401k plan, IRA, or other investment account passes or fails. But that's not all. If your portfolio gets an A, Ron will pay you $100. Go to PortfolioReportCard.com and find out if you pass or fail.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Welcome to the program. Great to have you with us. Coming up on today's show, portfolio report card for DP in El Dorado Hills, California. He's got a $696,000 investment portfolio. We will analyze it together. We'll look at cost, diversification, risk, tax efficiency, and performance. And I will give DP a final grade on today's program. Does he get an A, B, C, D, or F? Find out. Also coming up, our program guest is going to be Herb Blank. He's a managing director at S Network Global Indexes. We'll be talking stock market volatility, tax efficiency of ETFs. What does that mean? And much more. If you'd like to join us to talk about a particular stock, mutual fund, ETF, you want to talk about your portfolio, you want to get a portfolio report card, I'm game. 877-711-5611. That's the number. Give us your first name along with your city, and we will get to you. Now, coming up again, we're going to do this portfolio report card for DP. I'm going to give you all the details about his investment holdings, what he owns, and how he's allocated. We'll take a look at all the specific details. So, again, stay tuned for that. Now, let's take a look at what's happening in financial markets, get you caught up to speed on what's going on. Taking a look at the U.S. stock market, the S&P 500 closing down for the fourth straight week, and it's off 6.5% from its recent high on September 19th. Now, we've seen an uptick in volatility for U.S. stocks. Just to give you an idea of how much volatility has increased over the past 3 months, the VIX is up 82%. 82% rise in the VIX compared to a 4.23% loss in the S&P 500 over that same time frame. Now, to give you some perspective, and this is what I like to do, I like to give you perspective so that you can understand that volatility has been quite high despite the modest losses that we're seeing here in the stock market. Now, I look back, going back to that last significant sell-off that we had in U.S. stocks, which we have to go back to the time machine and rewind all the way back to April of 2011 to October of 2011. Now, between that time frame, S&P 500 slid around 19% in value, okay? Volatility over that same time span rose 156%. So that gives you some perspective on that almost 20% decline in S&P 500 and 156% rise in volatility. That was in 2011, the last significant sell-off that we had for U.S. stocks. Now, how does that compare to now? Well, we've seen volatility, as I just mentioned, rise 82% on just a 4.25% fall for the S&P 500. So that just gives you some perspective on how much volatility has really increased. And for you volatility bulls, it's been a great time to trade and be long the VIX. And this is something that I've done for my subscribers at etfguide.com. This has been one of our tactical trades, is to be long VIX, and I am pleased to say that our VIX trades are above, have gained on paper so far. We're not done exiting the positions, but we've gained so far more than 150% on these positions. So it's been a great trade for you VIX bulls, and volatility, at least for now, seems like it's here to stay. Now, taking a look at some of the other areas, we saw treasury bonds, long-term treasury bonds, really spiking in value, especially some of those leveraged long treasury ETFs, for example, TMF and UBT. Now, TMF aims for triple daily performance to long-term U.S. Treasuries. And over the past, let's just go back a month now, just to give you an idea of what's going on here. Over the past month alone, TMF has soared 18.5%. My goodness. This has been a great, great place to be. Long-term U.S. Treasuries, UBT, which aims for double daily performance to long-term treasuries, ahead by just over 12%. And Wall Street told you to sell your bonds, didn't they? They were wrong. They told you to sell your bonds. They told you that the bond bubble was about to collapse. Well, let me tell you, Wall Street was wrong, because long-term U.S. Treasuries has been a great place to be in 2014. And just taking a look at TLT, the unleveraged version that gives you exposure to long-term U.S. Treasuries, TLT ahead by 21.5%. Now compare that to the S&P 500 since the beginning of the year. Over that same time frame, SPY has gained around 3.5%. So long-term U.S. Treasuries continues to be a great trade. No, it's not a good income trade, because as bond yields fall, your income falls, but guess what happens? That's offset by increases in your bond prices. So that's where you're making money. This is a strategic trade. This is not an income trade at this particular juncture. And so that's what's going on there. We'll get you caught up on some of the other major asset classes if you're just joining us. You're listening to the Index Investing Show. I'm your host, Ron DeLegge. We're here every week at this same hour talking about the birds and the bees of successful investing. And really it begins with portfolios that are built, customized to match you, your unique investor personality. And then from there, it's up to you to minimize your costs to the greatest degree possible, because the less that you spend on investment costs, that includes not just your fund fees, but your commissions, that means more money in your pocket. Also, diversification, very important, having exposure to the major asset classes. And then, of course, risk, making sure your portfolio isn't subjecting you to hidden risks. And also, of course, taxes, making sure the orientation of your money is not creating a negative tax bill or tax burden for you. And then, of course, performance, which if you take care of those previous four things, cost, diversification, risk, and tax efficiency, your performance usually follows. And the performance is what I would consider, if you're doing well in those four areas, it would be what I would consider satisfactory performance, which matches or exceeds the performance of index ETFs. And that's the idea. That's your benchmark. That's your yardstick for what acceptable performance is versus unacceptable performance. 877-711-5611 is the number. You're listening to the Index Investing Show. I'm your host, Ron DeLegge. Just a quick reminder, if you ever miss our regular radio broadcast or aren't able to catch it for whatever reason, you can pick up our archive shows. They're available at indexshow.com/podcast. You can also catch us at Stitcher, STITCHER, along with iTunes. Just search under the Index Investing Show and be sure to give us a review. That way other listeners can find the program and benefit from what they're hearing. So we're going to do a portfolio report card on today's show for DP in El Dorado Hills, California. Now, if I'm not mistaken, that's near Los Angeles. DP is 54 years old. He's married. He's an engineer. He's got a $696,000 portfolio, and it's divided among a self-directed IRA, a 401k plan. We're going to get into all the nitty-gritty of his holdings, his asset breakdown. We'll get into his fund fees, his performance, his risk, diversification, the whole shebang. Coming up next, right here on the Index Investing Show. Go nowhere.
The Index Investing Show with DeLegge.
All right, welcome back from the break. You're listening to the Index Investing Show. I would say it's definitely a red flag if your portfolio is more volatile. If it's been jumping up and down like a Mexican jumping bean, or more than what the market has been doing, I would say that's a red flag. That's a serious red flag. And there's been some stocks that have gotten creamed here over the past week, several weeks. Ticker symbol GTAT, which declared bankruptcy. This was a company that was touted and promoted as a beneficiary of the Apple iPhone upcoming launch, which did not turn out to be the case. The company, like I said, declared bankruptcy. Shareholders completely wiped out. That's something that anyone that owns GTAT, call the show. Let's talk. How about Netflix? Netflix got creamed this past week. Fell around 20% or so in that vicinity. And so this is what you see in volatile markets. You begin to see companies that were once leaders sometimes become laggards. And especially if this market, the selling pressure picks up. Now, we did see a little bit of a recovery there at the end of last week. But again, these are things that you should be preparing for before the storm. You shouldn't be preparing your portfolio at the last minute or scrambling like the herds do. And we've talked to you about this on a consistent basis on this show. We've been rather consistent. And so these are the things that we're helping you to prepare for. Now, let's take a look at DP's investment portfolio. I'm going to do a report card for him on today's show. If you're new to the program, this is one of the features of our show. I analyze and grade your portfolios that you send to me. And the portfolio report card system that I invented is very simple. It basically tells you the strengths and the weaknesses of your investment portfolio in 5 areas: cost, diversification, risk, tax efficiency, and performance. And depending on how you do in each one of those areas, the final tally is either an A, B, C, D, or F. So if your portfolio does well in all of these areas, you're going to get an A or a B. If your portfolio does not do well, you're going to get a C, D, or F. That means you need to go back to the drawing board. You need what I call portfolio reconstruction. You have to maybe do a teardown, as they say. But these are the things that you need to be aware of so that you can put your money on track. And if you're there on track, stay on track. That's the whole point of the portfolio report card. It's not to embarrass you. It's not to criticize you. It's not to make you feel dumb. It's to help you have a realistic view about the financial condition of your money. So this is what the portfolio report card is all about. And by the way, if you get an A, I pay you $100. Go to portfolioreportcard.com and take my challenge. So DP is 54 years old. He's married. He's an engineer. He lives in El Dorado Hills, California, and he has got a $696,000 portfolio divided among a self-directed IRA and a 401k plan. Now, he's only got $16,200 invested in his IRA, so the bulk of his money is actually in his 401k plan. We're going to look at both of them, though. So DP owns 10 mutual funds, 9 individual stocks, and 1 ETF. He told me his goal is to retire by age 60, so he's got another 6 years to go. And although he considers himself an aggressive investor, he told me he wants to start getting more conservative. So let's take a look at the first area that I grade a portfolio on, and that's cost. And all well-built portfolios, I don't care how big or small they are, deliberately aim to minimize investment cost. That means minimizing or reducing brokerage commissions, fund fees, and other hidden costs or obvious costs to the greatest degree possible. That's what all well-built portfolios do. Now, the bulk of DP's portfolio, his 401k money, is invested in mutual funds from Fidelity. He's also got funds from Vanguard, as well as PIMCO and Janus. Now, his biggest holding is ticker symbol FGCKX. This is a Fidelity large cap growth fund. He's got around $137,000 in this particular mutual fund. It charges annual expenses of almost 0.75%. That's his largest holding. His next largest holding is a mid-cap value fund, ticker symbol FLPKX. He's got around $87,000 in that one. This particular fund charges almost the same expense ratio, 0.75% as the large cap growth fund that he owns. And then his other large positions, ticker symbol VIEIX, that's a Vanguard mid-cap fund. And then PTTRX, that's a PIMCO bond fund. In those two funds, he's got around $76,000 each. So this is the bulk of where his money is located. I would say on expenses, he doesn't do a terribly bad job. He certainly can do a lot better, though. Now, some of these large cap and mid cap funds, he could be paying probably 5 to 6 times less in a index fund than he would in his as he's paying right now. So, for example, one of the funds that he owns, VINIX, this is a large cap fund that invests in U.S. stocks. It's a Vanguard fund, pretty popular one. He's paying just 4 basis points, which is 0.04% annually. He's got $41,000 in that particular fund. And the other one, the Vanguard, the mid-cap fund that we just mentioned, VIEIX, he's being paid or charged just 8 basis points or 0.08%, which is very, very low. But the only problem I see is that I don't see a deliberate attempt to position his money in these types of low-cost funds. And I would like to see a DP do a better job of minimizing his cost in that area. Now, he also said, because he's got a brokerage window on his 401k plan, that means he's able to buy exchange-listed securities. That includes individual stocks and ETFs. So on his 401k brokerage account, he told me that the average is about 2 trades or less per month, and he pays around $8 per trade. So that also eats into his cost. But again, I mean, I think, as long as he can maintain a relatively low transaction, not go above 2, I think he should do okay. But if he starts, increasing his activity level there with the number of trades that he's doing on a monthly basis, it certainly can add up. But I think he's okay in that area. So on cost, not bad. He can certainly do better, though. In terms of diversification, the diversification rule that I have is exposure to all the major asset classes, not just the ones that you like, not just the ones that your broker likes or financial advisor likes. We're talking, there's really 5. We're talking stocks, bonds, commodities, real estate, and cash. Those are the 5 major asset classes that all diversified portfolios have at least some exposure to. Now, DP does have exposure to large cap U.S. stocks, mid cap. We also have some small caps. That's good. He's got exposure to international emerging market stocks. That's good. He owns ticker symbol. He owns a China fund. That's in his IRA, FHKCX. and he also has some exposure to international stocks via FDIKX. So he's doing okay there. We'll take a look at diversification and some of the other areas when we return. Coming up next, Herb Blank, my program guest, will be joining us. I'll be right back.
The Index Investing Show with Ron DeLegge.
Are you frustrated with how your investments never seem to grow? Do you feel like your investment plan might be off track? Are you concerned about your portfolio's fees, taxes, and risk? If you answered yes to any of these questions, you're not alone. Get the help you need with Ron DeLegge's free portfolio report card. Get a snapshot of your current investments and find out if your financial plan is really on track. Go to etfguide.com and click on Ron's portfolio report card. Millions of people are investing blindly in the stock market. Don't be one of them. Ron DeLegge's free portfolio report card tells you everything you need to know about your portfolio's fees, taxes, and risk. Go to etfguide.com and click on Ron's portfolio report card. Traditional IRA, Roth IRA, 401k plan, or brokerage account. It doesn't matter what you have. Ron's free portfolio report card will tell you everything you need to know. Go to etfguide.com and click on Ron's portfolio report card. Don't invest without it.
Why do we take unnecessary risk with our investments? Is it because we're gluttons for punishment, or is it because we're incredibly brave? Often, I think it's because we're simply distracted or unaware. We're pleased to have with us Herb Blank. He's managing director at S Network Global Indexes, and he's joining us from his New York City office. Herb, welcome to the Index Investing Show. Great to have you with us.
It's great to be here, Ron. Thank you very much for having me.
Let's begin with U.S. stocks, which are still posting year-to-date gains. But take a look at stock market volatility as measured by the VIX. It's up 100%, roughly 100% over the past 3 months alone. So my question is, higher volatility a prelude of trouble ahead for the stock market?
Well, it's a very timely question, Ron. And as a quantum statistician, I can't speak of U.S. market trends without noting that there is and has been tremendous seasonality, and that's especially true of midterm and election years and presidential election years over time. Historically and seasonally, this is the highest volatility month. So the quick answer might be high volatility the next 2 weeks, followed by eventually abating after the election, is a good possibility there. Of course, the long-term investor and investing for the future shouldn't be trying to track the day-to-day trades. For 90% of retailer investors and financial consultants out there, sometimes the best advice is 2 wads of cotton, one for each ear, where the daily and weekly movements of the market are concerned.
If you're just joining us, you're listening to the Index Investing Show, talking with Herb Blank, Managing Director at S Network Global Indexes in New York City. Now, diversification, as you know, has long been viewed as a cornerstone of proper portfolio management. But what about diversification during a stock market panic or a crash? And they do occasionally happen. Does diversification even work in that type of scenario?
Well, the market mavens like to say in a crash, correlations of everything go to 1. Now, there are major exceptions, and long-term bonds were an exception in the last couple of crashes, but not all of them. One persistent exception is gold, and I wouldn't say all commodities here, just very specifically gold. I used to be a consultant for the World Gold Council. But in general, yes, diversification. You know, normal state markets happen a lot more than panics, and in general, diversification does work. Obviously, you don't want to sell during a panic anyway, so that's a major point here. But the principles of diversification go far beyond correlation and work overall. Now, these days, you can get major market diversification very inexpensively in products like VT, Vanguard's all equity, total equity market, ETF, which gives you total penetration into all the world's equity markets in a proportional manner.
Now, the thing is, to understand about diversification, and this is an important point, I think, is that it's not a 100% hedge against losses, because market losses on paper, diversification is not going to prevent that. And I think it's important for people to understand that diversification, it's important, but it's still, it does have its limits, correct?
Absolutely 100% correct.
Now, let's talk about the definition of portfolio diversification, because there's a lot of different views on this. Now, let me just share with you Ron DeLegge's view of diversification. My definition is that broad exposure to the 5 major asset classes: stocks, bonds, real estate, cash, and commodities. Yet some might argue that commodities have no place in the average person's portfolio. What's your take on this particular asset class?
Well, it's again, the devils are in the details. It's all how you access it. Gold is more efficient to access than ever. Some may argue whether it's actually a commodity or a currency, but from a quantitative standpoint, it definitely has a place, and I think in everybody's portfolio. It's ballast, and it's ballast that has shown to be most effective when everything else is not effective. So I'm a big believer in commodities being in there. Other than that, you need and as you cover in ETF guide, efficient exposure to commodities. For those who use ETFs, I do want to point out, just both for GLD and the gold ETFs, as well as the commodity ETFs, you must look at your tax implications. Taxable investors need to look at it, because some of these commodity pools have some regulations by which they're taxed, and others are gold as a collectible is taxed at 29%. So you have to look at what's in there, because these products are not pure exchange-traded 40 Act funds. Now, the ones that hold stocks that represent the asset class are more like a typical portfolio. Now, there you're not going to get the exact performance of the underlying commodity, but you will get exposure to it.
If you're just joining us, you're listening to the Index Investing Show. Pleased to be talking with Herb Blank. He's a managing director at S Network Global Indexes. And ETFs are renowned for having very low annual capital gains distributions, which is good because it limits an investor's tax burdens. But the question is, are all ETFs tax efficient?
Absolutely not. And that's what I'm getting at. And again, the devils are in the details. Everyone has access to the fact sheet and prospectus. You want to look to see if this is a 40 Act mutual fund. That's first and foremost. If it is, and if the underlying are publicly traded securities, then the ETF provider has every means at their disposal, from a technical standpoint, to be able to have little or no capital gains distributions. If it is a different kind of product, again, there may be tax implications of which you're not aware, and it's important to read the prospectus and talk to your advisor, or as an advisor, be aware of what they are.
So let's just take a quick example. I'll throw a couple ticker symbols at you. XLB, which is the Select Sector Spider ETF that tracks basic materials stocks within the S&P 500. And again, that ticker symbol's XLB, versus DBC, which tracks futures contracts for a basket of commodities. The differences tax-wise, I mean, we're not going to drill down to the specific tax implications or tax rates, but just in general, again, hit on that point.
Yeah, XLB, the Select Sector Spider, which owns large publicly traded securities and is efficiently handled on baskets, has virtually no tax implications. The latter, the futures contract, may have a lot of embedded capital gains depending on the year. You also have, again, not to get too technical, but contango and backwardation plays a role in how it winds up being taxed.
Good point. Now, I'm a big advocate of the core portfolio and non-core or satellite portfolio strategy. The core, of course, is always the foundation, broadly diversified baskets or index funds with exposure to major asset classes. The non-core can be tactically invested in non-core assets, things like venture capital, private equity, managed volatility, etc., individual stocks. Those are all non-core assets. My question, is this a practical way for people to be building their portfolios, do you think?
I think it's the only way you should be building your portfolio, with emphasis on the strategic matching your objectives, goals, and guidelines, your age, your tolerance, all the essentials that go in there. Your strategic should stay more or less fixed over time, which means annually the only look you take is, to rebalance to your core. If the equity markets were hit quite a bit, you might want to ratchet up equity and vice versa. But other than that, you pretty much leave the core staying where it is. That's, almost by implication why it's your core. And then you look tactically at opportunities. And again, in looking at these opportunities, you want to pay attention to the fundamental soundness behind them, and you want to take a look at the tactical opportunities within the market, particularly whether it's expensive or inexpensive at that time, and the expertise of, if these are managed vehicles, the expertise of the person that, or the organization that's offering it. And one thing I will mention is everything in markets are time dependent. So when you look at correlations and things like this, or you look at how frequent something has happened, that's not a probability. I mean, you hear past performance does not guarantee future returns. The reason they have that is these are not probabilities. No one knows what the future is. And if you have a person in there, there's another variable there, because that person who existed, who managed well the last 5 years, you don't know what that person, who that person, or how they will manage the next 5 years. We're all human.
So, Herb, one of the questions I often get is, what's better, mutual funds or ETFs? A lot of this answer, the correct answer, depends on how people are accessing financial markets. But I want to tackle this claim that ETFs tempt investors to be less disciplined about their portfolios and about their investments. Do you buy into that claim?
Life is a series of trade-offs, Ron. For the most part, no. And from a technical standpoint, ETFs are mutual funds, but 100% more efficient in many ways. So from that standpoint, I'm a huge advocate of ETFs. The one thing that is easier to do with mutual funds, as present vehicles and distributors are aligned and take there, although more and more you see the TD Ameritrades trying to offer packages to help people in this case. And that's just to name one name. I mean, I meant to say all the electronic brokers. But you see to that, and that is dollar cost averaging. Dollar cost averaging is a great discipline that helps a number of investors. ETFs do not lend itself to that as well as the traditional funds. That's possibly the one advantage I can say in traditional mutual families now. But do ETFs make people trade too much? Do they make them be undisciplined? I find not there, not if you're a long-term investor, and certainly not if you have a good financial advisor who's fee-based and doesn't get paid on you churning your portfolio.
One last question before you take off. Speaking of discipline, something that often infects many investment portfolios is something called style drift. And with index ETFs, I mean, I guess this is one of the beauties that investors have, is that you don't have style drift. Explain that to our audience, what that means and why it's important.
Well, managers who are successful, I guess one of the best examples was Bill Miller at Legg Mason. He had a very value-driven mindset and portfolio and was very successful. No one else had ever outperformed the index 15 straight years. But the market had drifted, and the banks that he was seeing and financial institutions had very low multiples, and he thought had high value. It turned out the value was high for a reason, and he didn't catch on to it. In general, markets go through phases where they're too pricey, not pricey enough, and the markets are overvaluing or undervaluing certain characteristics. The broader the swath you own, BT being the extreme of it, Vanguard Total Market, the broader a swath you own, the more immune you are to the style drift within the market and the different managers' predilections within that market.
Those are some great points. You just heard from Herb Blank, Managing Director at S Network Global Indexes. I'm Ron DeLegge. Thanks for listening to the Index Investing Show.
Investing Show with Ron DeLegge.
All right. Welcome back from the break. And if you're just joining us, you're listening to the Index Investing Show. We're here every week talking about the birds and the bees of successful investing. You just heard from Herb Blank. He's managing director at S Global Networks, or Indexes rather. And we were talking about portfolio construction, where it begins. We talk about the core of your portfolio or the foundation. By now, if you've been a regular listener, you should know what that core is. The core is, the foundation always is, a broadly diversified, low-cost index ETFs touching the major asset classes: stocks, bonds, commodities, real estate, cash. Those are the major asset classes. So it's your job as an investor, if you're going to build a diversified portfolio, to get exposure to those areas. That's your priority. From there, once you've built that core, then the non-core or satellite part of your portfolio, which can include individual stocks, active funds, hedge funds, venture capital, IPOs, penny stocks, any other crazy ideas that come to your head, that's your non-core, that's your satellite. It can also include leveraged and inverse ETFs, but that is the area of the portfolio that complements the core. The core is the foundation. That's where you begin. You can't build the second story of a house. You can't build the attic without first building the foundation. And it's the same way with your portfolio. 877-711-5611 is the number. You can call us if you want to talk about a particular stock, mutual fund, ETF. You can also tweet the program. My Twitter handle is at Index Show. At Index Show is my Twitter handle. My email address, ron@indexshow.com. And again, give us your first name along with your city if you do call, and we will get to you. Now, if you haven't had a chance to take my portfolio report card challenge, I encourage you to do that. I will pay you $100 if your portfolio scores an A. But the only way you can know if you're going to get a good grade or bad grade is by taking my challenge. Go to portfolioreportcard.com. So far, I've graded over $15 million in investor portfolios, 401k plans, IRAs, trust accounts, you name it. And that number keeps growing because you keep giving me portfolios to grade, and I'm loving it. So take my portfolio report card challenge. Find out if your portfolio passes or fails. Go to portfolioreportcard.com. Now let's take a quick look at some of the industry sectors within the stock market that are performing quite well despite the increased volatility. These are a couple areas to put on your radar screen that are holding up better than the broader S&P 500, which, by the way, the S&P 500, for even all of its volatility, is still doing pretty good. We still have year-to-date gains in the S&P 500, SPY ahead by 2%, so still posting yearly gains. We'll see how long those last, but take a look at XLU, which tracks utility stocks ahead by 13%, and XLV, which tracks healthcare stocks ahead by just over 10%. Those two sectors continue to perform very, very strongly. Now let's complete the portfolio report card for DP. 54 years old, married. He's an engineer. We've been evaluating his $696,000 portfolio, which consists of an IRA and 401k plan. We looked at cost. He didn't do too bad, but he can certainly make some improvements in cutting his cost. In terms of diversification, we were talking about that. His portfolio does, I think, a pretty good job, other than the fact that he misses exposure to real estate and commodities. Those are two major asset classes that he has no exposure to. He does have exposure to stocks, he does have exposure to bonds, and he does have exposure to cash. So those areas are covered, but he does need to have exposure to real estate and commodities for his portfolio to be what I would consider fully diversified. In terms of risk, we want to see portfolios that match the risk profile and risk tolerance of you as an investor. So when I see a portfolio that's orientated in such a manner that it takes excessive risk or has a risk profile or characteristic that doesn't match you, then that's problematic. Now, DP told me very explicitly that he is an aggressive investor, but at the same time, he wants to get more conservative. Well, he's only got another 6 years to go before he told me he wants to retire. He's 54. He's aiming for 60. So he can't afford to see his money blow up in the next 6 years if the stock market tanks. So how does he do in terms of risk? Well, DP has 79% exposure to U.S. stocks, 5.4% exposure to international and emerging market stocks, almost 11% to bonds, and 4.5% exposure to cash. So when we add up his overall exposure to stocks or equities, he's got around 84.5% of his portfolio geared towards stocks or invested in stocks. Now, I would say even for a 54-year-old investor that's aggressive, that is a little bit on the high side. In fact, I would say that's hyper-aggressive. Someone who's 54 years old with almost 85% of their exposure or their portfolio to stocks, that's what I would consider hyper-aggressive, not just aggressive. So I think on terms of risk, he certainly can dial it down. That's for sure, because especially if we see the cycle for stocks begin to change from favorable to unfavorable, I mean, this is something that's going to definitely impact his portfolio, and it could really hurt. Now, in terms of tax efficiency, I don't see any problems with DP's portfolio. I mean, he's got his money, obviously, in retirement plans that the money grows tax deferred, but he has no outstanding 401k loans, which could pose a tax threat to his money if he suddenly leaves his current job. Also, he's not taking any premature distributions, so that's good. So he does well in terms of tax efficiency. Final category, performance. So from October of 2013, DP had a combined portfolio value of just over $577,000. That's where he began. That was his starting point. 1 year later, his balance has increased to $696,000. Now, after adjusting his performance for the $17,000 that he contributed to his retirement plan over the past year, after we make that adjustment, I calculated his 1 year gain, to be 17.6%. So how does that compare to the performance of a portfolio of index ETFs that match his overall profile? Well, our benchmark over that same time frame gained 7.73%, which means that DP outperformed by almost 10%. He blew the benchmark away. That's outstanding. DP's final report card is a B. He did great on performance. He did okay on cost. He needs to improve on diversification and risk. He did great on tax efficiency. But clearly, I think his weak spots, when I look at this portfolio just from a structural perspective, his weak spots definitely, I think, are risk. I mean, he's got almost 85% of exposure to stocks. And I think that's way too much, even for a 54-year-old aggressive investor. One of the other reasons this portfolio performed so well, some of his individual stocks like Apple and Disney and Novo Nordisk, ticker symbol NVO, performed extremely well. We're talking about gains in the vicinity of 25 to 38%. So that helped him. But again, that could easily turn. That could easily turn because obviously in an up market, the tide lifts all boats. But in a poor performing market, some of these stocks often do lose more value compared to benchmark indexes that are more diversified. So he got off in terms of easiness for over the past year just because we've had a favorable market, and that has certainly helped him. So I think if he could tighten up a couple things in his portfolio, hopefully this performance that he had over the past year will become a sustainable trend. Thanks again, DP, for taking Ron DeLegge's portfolio report card. That does it for another episode of the Index Investing Show. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the index investing show is permitted without the expressed written consent of its producers.